Environmental, Social and Corporate Governance, ESG. 1. Introduction. Environmental, Social and Corporate Governance, ESG, is a method of assessing how well a company is working on behalf of social goals. These goals go beyond the role of the corporation to maximize profits on behalf of the company's shareholder. Often, social goals promoted from an ESG perspective include striving to achieve a specific set of environmental goals, and a series of goals related to supporting certain social movement. The third set of goals is whether the company is governed in a way that aligns with the goals of the diversity, equity, and inclusion movement. Various government organizations and financial institutions have devised methods to measure how well a particular company is aligned with ESG goals. According to a 2021 study by the NYU Stern Center for Sustainable Business, which looked at more than 1,000 studies that use different scores for different companies from different data providers. Research shows that such intangible assets represent an increasing proportion of future enterprise value. While there are many ways to think about intangible asset metrics, these three core factors, ESGs, together form the label adopted across the U.S. financial industry. They are used for a myriad of specific purposes, with the ultimate goal of measuring elements related to the sustainability and social impact of a company or business. Global ESG rating agency MSCI uses the term from an investment perspective and defines ESG investing as considering environmental, social, and governance factors, as well as financial factors in the investment decision-making process. Likewise, S&P emphasizes that through ESG investing, market participants take into account the ways in which environmental, social, and governance risks and opportunities have a significant impact on company performance when making decisions. Investors who use ESG in their decisions are able to invest sustainably, while maintaining the same level of financial returns as using standard investment methods. The term ESG was first coined in 2005 in a landmark study at the 2005 conference titled, "Who Cares to Win?" A conference that first brought together institutional investors, asset managers, buy-side and sell-side research analysts, global advisors, and government agencies and regulators to examine the role of environmental, social, and governance value drivers in asset management and financial research. In less than 20 years, the ESG movement has grown from the Corporate Social Responsibility Initiative launched by the United Nations into a global phenomenon with over $30 trillion in assets under management. According to Morningstar, in 2019 alone, $17.67 billion flowed into ESG-related products. This is a nearly 525% increase from 2015. Critics claim ESG-related products have not and are unlikely to have the expected impact of raising the cost of capital for polluting companies, and blame this greenwashing movement.